Let's talk about guide to forex trading. The foreign exchange market is the market for exchanging foreign currencies. Forex is the largest market in the world, and the trades that happen in it affect everything from the price of clothing imported from China to the amount you pay for a margarita while vacationing in Mexico. What is forex trading? At its simplest, forex trading is similar to the currency exchange you may do while traveling abroad. A trader buys one currency and sells another, and the exchange rate constantly fluctuates based on supply and demand. Currencies are traded in the foreign exchange market, a global marketplace that's open 24 hours a day, Monday through Friday. All forex trading is conducted over the counter, meaning there is no physical exchange, and a global network of banks and other financial institutions oversee the market. Featured partner offer. A vast majority of trade activity in the forex market occurs between institutional traders, such as people who work for banks, fund managers, and multinational corporations. These traders don't necessarily intend to take physical uh, possession of the currencies themselves. They may simply be speculating about or hedging against future exchange rate fluctuations. A forex trader might buy US dollars, for example, if she believes the dollar will strengthen in value and therefore be able to buy more euros in the future. Meanwhile, an American company with European operations could use the forex market as a hedge in the event the euro weakens, meaning the value of their income earned there falls. How currencies are traded. All currencies are assigned a three-letter code much like a stock's ticker symbol. While there are more than 170 currencies worldwide, the US dollar is involved in a vast majority of forex trading. So it's especially helpful to know its code, USD. The second most popular currency in the forex market is the euro. The currency accepted in 19 countries in the European Union. Other major currencies in order of popularity are the Japanese yen, the British pound, the Australian dollar, the Canadian dollar, the Swiss franc, and the New Zealand dollar. All forex trading is expressed as a combination of the two currencies being exchanged. The following seven currency pairs that are known as the majors account for about 75% of trading in the forex market. How forex trades are quoted. Each currency pair represents the current exchange rate for the two currencies. Here is how to interpret that information using euro dollar or the euro to dollar exchange rate as an example. The currency on the left, the euro, is the base currency. The currency US dollar is the quote currency. The exchange rate represents how much of the quote currency is needed to buy 1 unit of the base currency. As a result, the base currency is always expressed as 1 unit, while the quote currency varies based on the current market and how much is needed to buy 1 unit of the base currency. If the euro dollar exchange rate is 1.2, that means 1 euro will buy $1.20. When the exchange rate rises, that means the base currency has risen in value relative to the quote currency and conversely. If the exchange rate falls, that means the base currency has fallen in value. 3 ways to trade Forex. Most Forex trades aren't made for the purpose of exchanging currencies, but rather to speculate about future price movements, much like you would with stock trading. Similar to stock traders, Forex traders are attempting to buy currencies whose values they think will increase relative to other currencies, or to get rid of currencies whose purchasing power they anticipate will decrease. The forward and futures markets are primarily used by forex traders who want to speculate or hedge against future price changes in a currency. The exchange rates in these markets are based on what's happening in the spot market, which is the largest of the forex markets and is where a majority of forex trades are executed. Forex terms to know. Each market has its own language. These are words to know before engaging in forex trading. Currency pair. All forex trades involve a currency pair. In addition to the measures, they also are less common trades. PIP, short for percentage in points. A PIP refers to the smallest possible price change within a currency pair. Because forex prices are quoted out to at least 4 decimal places, a PIP is equal to 0.0001. Bid-ask spread. As with other assets, exchange rates are determined by the maximum amount that buyers are willing to pay for a currency, and the minimum amount that sellers require to sell. The difference between these two amounts and the value trades ultimately will get executed at is the bid-ask spread. Lot. Forex is traded by what's known as a lot, or a standardized unit of currency. The typical lot size is 100,000 units of a currency, though there are micro and mini lots available for trading too. Leverage. Because of those large lot sizes, some traders may not be willing to put up so much money to execute a trade. Leverage, another term of borrowing money, allows traders to participate in the forex market without the amount of money otherwise required. Margin. Trading with leverage isn't free. However, traders must put down some money upfront as a deposit, or what's known as margin. What moves the forex market? Like any other market, currency prices are set by the supply and demand of sellers and buyers. However, there are other macro forces at play in this market. Demand for particular currencies can also be influenced by interest rates, central bank policy, the pace of economic growth, and the political environment in the country in question. So guys, we'll end this interesting video. Goodbye.